Hi, and welcome to today's class, where we will be covering audit risk and evidence. There are four critical components of risk that are relevant in conducting an audit. There is business risk, financial reporting risk, engagement risk, and audit risk. Business risk is the risk that affects the operations and potential outcomes of organisational activities. Financial reporting risk is risk that relates to the recording of transactions and presentation of the financial data. Engagement risk is the risk that auditors encounter by being associated with a particular client, including loss of reputation, inability of the client to pay the auditor, or financial loss. And finally, audit risk is the risk that the auditor may provide an unqualified opinion on financial statements that are materially misstated. Auditors will attempt to reach a certain level of audit confidence in relation to the financial statements. The confidence is opposite to audit risk. For example, if an auditor is 90% confident in their opinion, then the audit risk is 10%. The audit risk model allows the auditor to consider the following. Complex or unusual transactions are more likely to be recorded in error than are simple or recurring transactions. Management may be motivated to misstate earnings or assets. Better internal controls mean lesser likelihood of misstatement. The amount and persuasiveness of audit evidence gathered should vary directly with the likelihood of material misstatements. As we touched on in a previous recording, the components of the audit risk model are inherent risk, control risk, and detection risk. Inherent risk is the possibility that misstatements are contained in the financial statements and are higher for some items. Complex transactions, for example, are more likely to be misstated than simple transactions, as are estimated balances rather than facts-based balances. It is the likelihood that a material error or fraud exists in an account balance or class of transaction. Control risk. This is the possibility that misstatements will not be prevented or corrected by the internal control system. No matter how good or extensive the internal controls are, there are always limitations, and there is a possibility of human error, fraud, collusion, and inability to cope with unusual transactions. Detection risk is the possibility that substantive tests of transactions will fail to detect material error or fraud in the financial statements, and it relates to the extent and quality of the audit test, including the size and design of samples tested. So what does our model look like? Audit risk is equal to inherent risk multiplied by control risk multiplied by detection risk. And this diagram considers each of the risks. So first of all, we determine our acceptable audit risk, for example, 5%. We need to consider the industry and background information, assess inherent risk, and followed by calculation of detection risk. On the opposite side, we are investigating internal controls, assessing the control risk, testing these controls, and reassessing the risk. We then design substantive tests based on the detection risk. Outlined in the slide is an example. What are the limitations of the audit risk model? Well, inherent risk is difficult to formally assess. Audit risk is judgmentally determined. The model treats each risk component as separate and independent when in fact they are not. And audit technology is not so precise that each component can be accurately assessed. So many auditors will use the model as a functional rather than a mathematical model. In the instance of financial statements, they should be prepared on the assumption that the entity is a going concern. This means continuity into the future. If there are any doubts, audit risk will increase because management may try to window dress or falsify the accounts. ASA 570 covers going concern and lists indicators of going concern problems. Operating indicators include lack of management planning, skill, the loss of key management, the loss of significant market license or franchise, and also problems in the management information system. There are also financial indicators, recent history of losses, high reliance on borrowed funds, unfavourable financial ratios, lack of operating cash flows, and an inability to pay creditors. We now look at the evidence in the audit process. ASA 500 covers audit evidence and notes that the auditors should obtain sufficient and appropriate evidence during the audit. Compliance tests test controls, and substantive tests obtain evidence in relation to misstatements in the financial statements. The substantive tests include tests of balances, transactions, and analytical review. The auditor has to obtain the right quantity and the right quality of evidence. So this is sufficient and appropriate evidence. And their basic sources of this evidence include the knowledge of the business and industry, analytical procedures comparing the entity to industry to past results of that entity and expectations, tests of control, and also the direct tests of account balances and transactions. As we described in an earlier recording, audit objectives become assertions. Management is essentially asserting that the following are present in the financial statements: existence, occurrence, valuation, measurement, disclosure, rights and obligations, and cut-offs. What is existence? Existence deals with whether assets or liabilities exist at a given date. Completeness means that all transactions and accounts are presented. Valuation deals with whether an asset, liability, revenue or expense component has been included in the financial report at its appropriate amount. Measurement: are transactions recorded at appropriate dollar levels and in the correct period? Presentation, disclosure, and assertion deal with whether the information is appropriately presented. Rights and obligations deal with whether the entity has the right to the assets and the obligations of the entity's liabilities at a given time. And finally, cut-off assertions deal with whether the transactions have been recorded in the correct accounting period. This assertion model is a very important concept within this auditing unit. So what are the types of audit evidence? Auditors carry out a range of activities in collecting different types of evidence, both documentary, physical, representations, oral, confirmations, mathematical and analytical. Your teacher will run through examples of each within class. The audit procedures for collecting evidence are inspection, observation, confirmation, inquiry, tracing, vouching, recalculation, counting, and analytical reviews. And again, your teacher within class We'll give you examples of each of the following. The auditor needs to gather sufficient evidence, and it's important the sample sizes are large enough in order to do this. And they also need to gather appropriate evidence, meaning appropriateness relates to the quality, relevance to statement assertions, and audit objectives and reliability. Audit documentation is important to be kept in the form of working papers. They can be written or electronic. They are a record of evidence accumulated during the audit and must be maintained in separate files as a current and permanent file. The current file contains the current year's work, whereas the permanent file would contain previous year's engagement letters, industry and economic information. Please complete the following questions in class, and thank you again for your time.